What if you can build an income stream that grows year by year? And hopefully, fingers crossed, your portfolio value goes up as well. Today, I'm going to be sharing 10 really good dividend stocks if you're in the UK to potentially purchase. Now, these picks all have a good dividend growth CAGR, and they also have a pretty good stock market performance in price appreciation. This is a combo that I'm looking to kind of leverage to build my £1 million portfolio over the course of the next 16 to 17 years. Now, whilst researching this video, I've actually found that I need to do a pretty big change to my own portfolio, but if you want to follow along, please do leave a like, subscribe, and you'll catch that one in the next video at the end of this week. So why do dividend stocks matter? Well, it's just one form of vehicle if you're looking to grow your overall net worth in terms of investments, right? So I did a video last week essentially talking about how high yields will kind of burn you. But here's the thing, right? A 3% yield may well grow over 7, 8, 9%, depending on what it is. And it then becomes more and more powerful, which is why you need to look at the dividend growth of your stocks instead of what you're getting paid today. However, that being said, if you're old, if you're retired, you may want to get paid earlier, but you've got to kind of look at the payoff. Do you actually get performing stocks, or do you get the stocks that actually just nosedive? Normally, it's the latter. They tend to drop off quite a lot. Now, as I've just alluded to it, dividend growth is not about the payments today. It's about the income for tomorrow and the long term and the longevity of holding a stock. That can be quite bulletproof. And we're going to go through 10 stocks that are slowly compounding portfolios, and they have been for decades, which is kind of the whole point of this video. So yeah, strap in, sit back, take some notes, and stay till the end, and you'll see the overall performance in chart form, and you can basically have a little look and see what you feel for your own portfolio. Everything that I say in this video is for entertainment purposes and not financial advice, so please do your own research. I'm just pointing you in terms of what I like and why I probably should be holding some more of these instead of ones that I'm not. Now, the first stock is called Halmer. It has a decent dividend growth yield of roughly around 7%, and I'll showcase this in a minute, but it has quite a low yield, as you've probably noticed on the top right hand of the screen, which is fine, but it is a bit of a hidden gem. It's had 46 years of straight dividend increases, which is pretty impressive. And they do have an acquisition model of safety kind of elements around niche products, and it is quite a small cap asset realistically among the dividend abstracts. The problem we have with this is the dividend yield is unattractive, but it is a slow growing compounder, which is quite nice. And the price has been relatively stable depending on how you look at it. It does go up, but it does have some violent drops as well. It has done during COVID for obvious reasons, because no one was allowed out. But when we look at the details and the data here, you can see overall the growth of this has been pretty damn nicely. In terms of the metrics that we have on this website here, which is the link below if you're interested, it does showcase enough, but not all of the information. But over the last 10 years, you can see very, very clearly their dividends have been growing, which is kind of what you want, right? So all of that is kind of an interesting metric, but this is, as I say, the only metrics that we have so far. Regardless of what you are looking at, you tend to find that some websites you don't get the full picture, but if you're looking at least 5 years, it's quite good. And this is just an obvious one in my viewpoint. And again, you can talk about the financials, growing, looking pretty nice, neat, tidy. There's no real dramas here. So it's quite a solid pick to put in your portfolio. Now, again, another nice one is called Relx, which is an interesting company. It's mainly data, and I have talked about this in another video. There's a link below in the description. And it's all about analytics and high recurring revenue and strong margins. One of the best performing UK stocks over the last 10 years, as you can see. And I feel like I'm pretty late to the party, but it is still a very, very, very solid asset. And again, we're going to have the same pitfalls. It's got low dividend yield, oh my God. But ultimately, it is paid out a reliable dividend, which is fantastic. More often than not, you're probably going to argue certain things. Again, we still have the overall metrics quite low here on the UK side of it. But overall, you can see it is a dividend grower, and it has been growing quite stably over the course of the last few years. And again, going down to the payout history, it all looks like it's going up, which is kind of what you want. So another solid one, if you're looking for a compounder in your portfolio, pretty good option. Now, another solid stock is Diploma, which is a bit of a weird one. You probably argue, what the hell is this? It's, I think, criminally underrated. It's a 25 years of consistent business increases, and it's just distribution of engineering core control products. It's quite boring, but it does offer, as you can see, incredible price results. And again, I feel like I'm late to the party here, but at the end of the day, it has solid growth. It does have low dividend yield, which I know you're probably thinking, oh, here we go. But at the end of the day, look at the side of this side of it. The dividends are growing quite a lot, and they have been, which is what you want. And again, look at the payouts. Apart from COVID, it's been pretty reliable, pretty strong, and that's kind of what you want. And realistically, you've got to look at the overall picture here. This is a solid compounder like the other two. Now, Games Workshop. You've probably heard of it if you're in the UK, but ultimately, there's a little bit of a discrepancy with data on this website, but I do know that their dividend growth has been pretty good over the course of time. But as you can see, yield's a bit higher. They've got a decent payout ratio, but more importantly, they are growing as a stock and they're doing fantastically well. A very, very cultish kind of fan base, you could argue. Strong IP, Warhammer, special dividends. The business is very, very, very profitable as well. And even though we don't have massive amounts of data here, their dividend is actually growing. Yeah, you could argue the streak has been removed a little bit here, but nothing crazy. But reality is it has been growing over the last few years and probably will continue to grow because their profits are pretty good. So yeah, it's one of those, probably they're not the most up-to-date data here, but as you can see, in terms of the financials, they are quite happily growing, which is kind of what you want, and there's no real dramas here. So overall, in my opinion, probably Game Workshop, one of those ones that are probably grabbing the headlines right now for price appreciation, but overall, under the hood, they do have solid dividends. So a bit more data on Games Workshop. It's a bit of a weird one because they have reduced their payout ratio from much, much dizzier heights. And that has led to the dividend yield actually dropping in price, which is fine, but you are still getting more bang for your buck realistically, right? So even in 2023, it was a bit higher. It has dropped a little bit, quite a lot. But one thing that is very, very interesting is you can see here, if I could scroll down, the overall payouts 100% or over 100% payout ratios have been dropping. So it looks like they're reinvesting more into their company to do other things, which is going to be very, very interesting. So keep an eye on it. But dividend per share data is still showcasing it is still rising. So it is doing pretty well. And just to kind of back it up, if you're looking at the element around the income statement, that is still all growing, which is what you want. Now, another interesting one is a London Stock Exchange. Massive tailwinds from the world of data. They've had some acquisitions, which has enabled more distribution. They're still reinvesting very heavily, but the dividend is still growing fast from a pretty low base. You can see here 1.3% yield. However, overall, it's a pretty decent one because their growth streak's pretty good. Their overall growth metrics are really, really high, and you can see some massive, massive compounding elements here. More importantly, you can argue the revenue of it is growing quite a lot, and there has been acquisitions, certainly be some big jumps in revenue. So again, yeah, it may be low. Dividend CAGR is pretty high, and it has decent price returns over the last 10 years, which is kind of what you want. So City of London Investment Trust is one of the higher yield ones we're going to talk about now, and it's done pretty well. It's got 57 years of dividend increase. I know the screen doesn't say that, but the data is a bit wrong on this website. However, it does actively manage income-focused investments, trust investments as well, such as Shell, such as Unilever, Diageo, stuff like that. So it's sort of like a long-term stability one that grows. It's a foundation stock. And we've been talking about the lower yield side. Now to mix it up a little bit with a bit more higher ones. And it's a City of London, set and forget. It's going to compound. And this is an asset that I should be holding. And I'm probably going to do something about it. A little bit of a spoiler alert here. So again, you can see it's doing pretty well in terms of price performance. Its dividend has been pretty steady, growing, and the yield's pretty high, but overall the performance is pretty good. It's not amazing on payouts, but ultimately it's not going down, it's not going crazy, it's relatively good, and the price is doing the magic, realistically. Now, an obvious one that is in my portfolio, yes, it is a lower dividend yield, but it does have consistent growth, which is obviously BAE Systems. And it's been around for a while. You all know the defense sector, it's kind of obvious. And their yield is really, really good in terms of growth as well. So it's a solid one. As you can see, it's compounding up quite nicely. The payouts have been pretty nice over the course of the last couple of years. So yeah, it's kind of really an obvious one to just pick in as an overall UK performing one. So a part of the niche for retail pensions, Sun Life and stuff like that, is Phoenix Group Holdings. Now, on the data, it doesn't look amazing, 34 rating on the dividends, but I think that's a little bit skewed. However, high yield, which is quite important for some people here, but more importantly, they do have dividend growth, which has been growing consistently over the last couple of years. after a very, very interesting period. So over the last 5 years, it has been growing its dividend, looking pretty strong and starting to reclaim some of those monies back. But also the price performance is looking pretty good. High yield, price performance, growing dividend yield, might do all right. And the final one is Bankers Investment Trust. They hold many different companies, as always, as a fund, but performance is relatively good. Performance of price, really good. Dividend growth, really, really neat and tidy, growing up quite nicely. And yeah, you can argue a lot of things here, but main thing you can argue is growing its dividend, and it has been on a streak for a very, very long time. Actually, in fact, 58 years. So it's one of those obvious ones, kind of put it in your portfolio. And yeah, I'm going to be doing some changes to my own portfolio after the back of me doing 2 to 3 hours research, looking at many different things. So as I've said in the video, I'm looking to do some changes to my own portfolio. So please do follow along for more information on that, because I feel like for me, I need to increase my yield a little bit with more solid options, such as trust funds and stuff like that, because they're kind of like a little bit of a do-it-all sort of vibe, right? And that's important. And my core plan is just continuously dollar cost average into high-quality stocks that are probably going to survive. And regardless of what, could happen in terms of the economy or inflation sprees or obviously recessions, etc., they're important to note that they're always going to continuously pay. Some of these stocks that I talk about have been consecutively raising their dividends for 50 plus years, some of them into their 20 years, which is huge. So you've got potential growth, you've got reliable compounding, which is important, but you've also got low volatility income, which is kind of what you want with an ISA, which is the whole point of this. And with a stocks and shares ISA, over time, that should be allowed to compound and should become not so much high yield. It shouldn't just be low yield. It should be a mixture of all, and then it averages out into a much, much better portfolio. But you don't want volatility. You do not want to see your assets go down 3, 4, 10% in a day. And this is why I'm looking to remove some positions, such as Greg's, for, in my opinion, I'm looking to sell. Bit of a spoiler alert, but performance of that has been awful since buying it. And I don't think it's going to get any better when you look at the shoplifted element and obviously the performance, blaming it on the weather. I don't like that. They are literally blaming their performance on the weather. So when you're looking at top dividend growing stocks, you need to find the ones that are going to continuously grow, but not get burned by market parameters that may well change, such as a hot day, you're not going to go to Greg's, which makes no sense because often you find that the sausage rolls are cold. So yeah, the next time you tune into one of my videos, I will be doing some changes to my portfolio. Yes, some of the assets that I've talked about today, I do actually hold, and I will continuously hold them. There's some assets that I've talked about as well today, and I've learned about during my research, that I think will happily benefit my portfolio, increasing the passive income, increasing the growth compound effect. And I have taken on board a lot of comments from people. People have said I need more higher yield, which I understand, but I also need to remain that nucleus of foundation of growth. So I'm hoping this video gives you 10 options, hopefully, that are a bit of a mix. Not the obvious in the room, not the, oh my God. And I could have went for much, much more. There was a lot more assets I could have picked here and put it in the video. Even ones that I actually hold, I have not even given you them all. Drax, for example, in my opinion, is a good one. You've obviously got Coca-Cola, HBC is also another good one. Tesco, even Sainsbury's that I don't hold, is a really, really good, solid asset as a company. But there's others out there as well. So I hope this gives you a little bit of a guide, a bit of a starting point to put in maybe 2 or 3 compounding stocks that will help you in your portfolio. Obviously, do your own research. Remember, consistent reinvestment is the key here in quality stocks that are going to grow over time. Certainly their dividend, which means you're going to get paid for longer, which is important, right? You want to get paid more for the shares that you bought 10 years ago versus nothing in the next day. Anyways, subscribe, leave a like and comments as always. But the next video, it's going to be a full revamp of my portfolio.